The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Hello and welcome. You're watching Financial Planner. Today we're going to be discussing a very important and interesting subject for all our viewers, the importance of investing wisely. To help us understand this better, because this is of course the crux of making any sort of investment decision, is Hemant Rustagi, CEO of Wiseinvest Advisors. Thanks Hemant for coming back to the studios today. Hemant, of course, we talk about various assets of investments, various instruments that viewers and investors can look in. But why is it important to invest to begin with? Because like we were just talking about it before the show started, there are two large sections of society. One who goes out there and spends way too much of money, living the typical American dream, if I can call it that. And another large growing middle class that is actually believing in saving and investing, I guess.
Yes, I think investing is very, very important, because let's not forget that, we work so hard to earn money. So we want this money to grow. And, all of us have needs. I mean, we have short-term goals, we have medium-term goals, we have long-term goals. All of us have that. I think it's very important for investors to start looking at it in an early stage, so that you can build up the nest egg or enough money for different goals that you have in life, and make sure that you never have a shortfall. So I think investing is very, very important. I would say it's as important as earning money, because what we see, most of the people are working so hard to earn money, but they hardly spend any time in terms of when it comes to investing money. So I think both are equally important.
Hemant, old school, of course, you will save quite a lot of money. You probably would keep it in cash, if nothing else, or probably invest it in jewelry. How is saving different from investing? Why should your savings be invested?
Well, it's very different, and it's very important to understand the difference here. Right. Saving is like keeping aside some money out of your earning.
Right.
Okay. Now the thing is, there is something called inflation. Okay, inflation means the cost of living is going up over a period of time. Right. So what happens is, if you don't invest that money judiciously and in the instrument where you can beat inflation, you end up actually having a shortfall in terms of what you wanted to achieve and what you actually achieve. So I think it's very, very important to understand that you have to invest money properly. Saving is not enough. Saving is just keeping aside some money. Investing is very, very important.
So you've got to make your money work for you, as opposed to being the other way around more often than not.
Oh, definitely. How much success you achieve with your goals or from your investment depends on how you invest your money. So I think it's very, very important to make sure that you invest your money properly, understanding the risks that are associated with any investment option, and knowing exactly what you want to achieve with your money. So if you do that, definitely that makes a difference to the end result.
Hemant, and that comes down to our topic of discussion today. What is the importance of investing wisely? Everybody says it's always good to invest wisely to generate long-term wealth, to, watch out for a rainy day, all of that. Why is it important to invest wisely, and what is investing wisely?
It is very important. You see a lot of investors investing in a very haphazard manner. What it means is they don't have any goals in life. They don't really, decide as to what they want to achieve with their money. So whenever you're saving some money, whatever instrument you come across, anybody who comes and tells you that you invest there, you invest your money, that is not actually the right way of investing. That's what we call haphazard way of investing. Okay. Why investing properly or wisely is important is because, there is something called an asset allocation. The asset allocation is a method through which you decide how much money should go into different asset classes. You have equity, you have debt, and you have commodities like gold, you have real estate. Now, you allocate funds to different asset classes. That's because all the asset classes do not behave exactly in the same manner over a different period of time. Now, if you invest all your money in one asset class, you actually may end up taking much more risk than you can take. But if you invest all your money in debt instrument, you may actually struggle to beat inflation. So it's very, very important that we have a proper investment plan before we start investing. Because if you have an investment plan, what you do there is you list out your goals. Okay, you have short-term goals, you have medium-term goals.
That's how one would invest wisely, is by starting by listing your goals.
It's absolutely, because I believe that, investing without a plan is like traveling without itinerary. So if you do that, you're sure to have a lot of problems. Right. So I think when you have a plan, it makes sure that you remain focused on what you want to achieve with your money, rather than, putting money, everywhere and not achieving anything out of it. Right. So have an investment plan in place, list out your goals, assign them a time horizon. This is very, very important.
It's time-based goals is what
it is absolutely important, because when we talk about investing for the long term, what are the goals? You have child education, marriage, you have retirement, Okay, on the medium term, you may have a goal of like buying a house. On the short term, you may have buying a car or going for a holiday. The moment you assign them a time horizon, you know exactly how much time you have to achieve this. Now that helps you in deciding in which asset class your money should go.
So going on holiday could also be a goal.
Well, surely.
Okay,
Today,
so
traveling is very, very expensive. You want to go abroad, it's just that you can't just get up and say, okay, I want to go. You need to plan. You need to plan your itinerary. You need to plan for the money, because a foreign trip can cost you a few lakhs. So it can be one of the goals. So you assign a time horizon to that, and these two things help you in terms of deciding your asset allocation. Because when you're investing for the long term, your focus has to be on beating inflation. And that is where equity comes into play.
Right.
When you invest the short term and medium term, the focus has to be on preservation of capital and also investing in an instrument where you can get better tax efficient return. So when you decide your asset allocation based on that, what it does for you is it ensures that you remain disciplined. Many a times you've seen investors, when the markets are down, moving money from equity back to debt. When the markets start moving up, they move money back from debt to equity. When you stick to your asset allocation, it ensures that you remain disciplined about where your money should be, and I think that helps a great deal. In fact, I would say 80 to 85% of investment success come from the kind of asset allocation you have, and the remaining 10-15 from the instrument that you invest in. And unfortunately, we spend maximum time looking for this investment option, and we don't give importance to asset allocation. So I think that's very important to follow a process through which one decides how much money has to be invested where.
What would the ideal asset allocation be? Would that be like a thumb rule on that, or not really?
Well, there is a thumb rule which says that, whatever your age, that part of, portfolio should be in debt, the rest should be in equity. But that's a thumb rule at the end of the day. It all depends on your own personal situation. Okay? There are certain people who have responsibilities. They have to ensure that they can't take much risk. There are some people, even at the age of 70, can take risk. They can have majority of the portfolio in equity. So there is a thumb rule which you can follow, but I think the best thing to do is to look at your own personal circumstances, look at what responsibilities you have, what goals you have, how much risk can you take, and then decide your asset allocation.
Hemant, of course, inflation, that seems to be the devil in the detail, right? Especially in a country like ours, which is growing at a 10% rate. You've said that invest in tax-efficient options to beat inflation. Can you help us understand what this means? Because, of course, tax efficiency is also extremely crucial and something that's a driver for a lot of people investing.
Oh, it is, in fact. There are two aspects of it. One is like you have this instrument where you can save tax. The second is the tax efficiency of the return, which is very important. And it's important not only for the long-term investment, but also for the short-term investment. You see, for example, if you look at investors investing in equities, as of today, the current laws say that any gains that you make out of any investment in equity, realized after 1 year, after 12 months, is tax-free. So imagine like if you're investing for 10 to 15 years and you have huge target amount, because when you talk about, let's say, retirement, you may have a target of 2 crore, maybe 4 crore, depending on the time you have. So it's very, very important that you invest in investment options where the returns are tax efficient. Even on the debt side, if you see, why tax efficiency is important, that is because the debt returns are low. So if you look at traditional options, let's say a fixed deposit, and if the return is, let's say, 10%, and someone who is in the highest tax bracket will pay 3% tax on that. So the net return for him is 7%. Tax efficiency is important here because when you look at mutual funds, which are more tax efficient, if you invest in a debt instrument, let's say a fixed maturity plan, and that gives you same return, 10%, you end up paying capital gain only at 10%. And if you claim indexation, then it's only 20%, which means that even less than 10%. Now, you see the difference here. There, what you got was 7 after tax. Here, you're going to get 9 or 9.5. 2.5% on a debt instrument is quite a lot. So I think it's very, very important that we look at those instruments which are tax efficient. Unfortunately, a lot of investors in India are comfortable with traditional options. You have bonds, you have fixed deposits. I think it's time that they look beyond that. There are other options which are available outside, which are smart options, and at the same time, they are very tax efficient.
Right. Hemant, also, of course, a lot of us try to time the markets. When the markets are going down, you generally feel the need to stay away and, preserve capital. Other times, like what we're seeing right now, a lot of people are feeling left out only because no one imagined the rally that we saw in the last 2 months. I believe through investing wisely, you don't really need to time the market because nobody can time the market. So how do you get this right?
Well, I think we know we need to understand the characteristics of an asset class. equity has the potential to outperform all other asset classes. But there's also a fact that during short term and even medium term sometime, it can be very, very volatile. So how do you tackle volatility? What you do is, if you set up an investment process wherein you invest on a regular basis. Now what it is, you have a system called systematic investment plan. Now what you do in systematic investment plan is that you keep investing a fixed amount at a predetermined interval. Now what it does for you, it takes away the element of timing the market, because we always have a temptation of time the market. All of us would love to do this, is to invest just before the market goes, and also sell when the market is about to go down. But even the best of the experts find it difficult to actually do this on a consistent basis. So I think for every investor it is important to follow a disciplined approach. Another advantage of that is you get into a mode of investing regularly, which is, I think, 50% of the success comes from there. Many of us do not have a discipline of investing regularly. So on one side, a part of your money goes into your investment. On the other side, when you invest in an asset class like equity, you benefit from averaging, especially when you invest for the long term. So I think setting up a process wherein you invest in a disciplined manner basically ensures that you achieve a lot of successful investments.
Well, there you go. If you're looking to make your money work for you and create that long-term wealth, make sure you're investing wisely, regularly, and have a more disciplined approach to creating wealth. We'll slip into a break on that note, but when we come back, we'll take up all your financial planning related queries with Hemant, so stay with us.
The Financial Planner, presented by the Bombay Stock Exchange, IPF. The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Welcome back. You're watching Financial Planner. It's now time to take up all your financial planning queries that you've sent across to us.
Investment Ladder, presented by BSC, Investors Protection Fund.
Hemant, we've got a query coming in from a lady called Sheetal Joshi. And she says she's earning about 26,000 rupees per month, and her husband earns about 70,000 rupees per month. The expenses, including the EMI, which is about 13,265, is about 45,000 rupees. That's what they're, of course, spending in running the house and looking at other expenses. They're looking to invest about 35,000 per month between the two of them. Currently, out of her salary, she says she's invested in the LICs, different policies up there. She does an SIP for about 6,000 rupees, again, a couple of 6 different funds is where she's investing in, and puts about 10,000 per month in an SBI PPF, and recently started putting 4,200 in a recurring account as well for 40 months. She's 30, so she's fairly young. Her husband's 32 as well, and both are working for a private company. They've got a few goals that they've listed out to us as well. They've got the key goal being their children's education. They currently have a kid who's 2 months of age. They're already thinking about his marriage, which is great planning, and of course, a regular income for their retirement. And they want to look to buy a car in the medium term, and of course also acquire a home, which is probably one of the most expensive investments of any Indian. They'd like you to help them with what they should be doing, how they should be investing their money smartly across mutual funds, LICs, recurring deposits, debt funds. What's your call?
Well, I think before we get on with their investment goals, I think the first thing that I would like to talk about here is the risk cover that they have. There are 3 policies. We don't know whether they are traditional policies or they're term policies. It's very important that one has adequate risk cover. Okay, now the thumb rule for that is that it should be 10 times of your annual income. Because in this, we can't really make out whether these are traditional policies or not. So I would like her to relook at her insurance plans, and if these are unit-linked insurance plans or traditional plans, okay, then I'm sure about one thing, that the risk cover that they have is not adequate. So in that case, if there is a shortfall, they must look at a term plan and make sure that they are adequately insured. That is the first thing that I would like them to do. Now, if you look at their investment goals, let me begin with 3 goals that they have. All 3 are important long-term goals. One is the child education, okay? The second is the marriage, and the third is their own retirement. You see, that is what I think every investor needs to be aware and be careful about. The goals are there. There is no time horizon which has been set, and there is no target which has been set. We just talked about what is the right way of investing. I think this is the first thing that investor needs to do. Anyway, to try and help her in understanding what the process should be, we will make certain assumptions. And we'll say that, okay, 18 years is the time when she requires money for the education of the child. and 26 years is the time horizon when they need money for the marriage, and looking at around 29 years, I'm taking the average age for the retirement, is around 29 years for retirement.
That's from now.
So we'll set a corpus now, let's say a corpus of 50 lakh for the education, and 30 lakh for marriage, and 4 crore for retirement.
Of course,
basically assuming, yes, inflation, I'm looking at basically if they want to maintain the same standard of living that they have today. Now, when you invest for this kind of time horizon, clearly, as we discussed earlier, the focus has to be an asset class where you can beat inflation, which is where equity comes into play. Equity as an asset class definitely is risky, as we know. But if you invest for such a long term in a disciplined manner, the volatility is automatically taken care of. So I'm assuming, looking at the time horizon, an annualized return of, let's say, around 15% here. So for the first goal, they need to save and invest around 5,500 rupees per month. For the second goal, the investment has to be around 1,000. And for the third goal, that is for retirement, it's going to be around 8,500. So in all, they need to invest around 15,000 in good quality diversified equity fund. Some of the fund that they can consider are HDFC Equity, IDFC Premier Equity, which is a mid-cap fund, ICICI Focus Blue Chip, which is a pure large-cap fund, and Reliance Equity Opportunity. So out of these 3 or 4 funds, they can start investing this. There are other couple of goals also that they have. One is, I think, to buy a car, and also looking at an additional home. Here again, I think they need to set a time horizon, depending on how quickly they want it. Right. The portfolio the composition has to be in accordance with that. I'm assuming that the car buying will happen in the next couple of years. So in that case, the focus has to be more on the debt fund. At best, they can look at debt-oriented hybrid funds like MIPs. They can start investing in that. So they have 35,000 rupees to invest, I believe. 15,000 will go into this. The rest of the money is there that can be utilized for, money for creating a corpus for either buying a car as well as the additional home. A couple of things I would like to say about their existing investment. They're investing 6,000 rupees in 6 months. Now, this is a pure case of over-diversification. Yeah. One should never do that. For a 6,000 kind of investment, you should not be having more than 2 funds. At best, you can have a large cap fund and a multi-cap fund, or a large cap fund or a mid-cap fund. Do not invest in 6 funds. Second is that they're also investing through a recurring deposit. I can understand the need to invest in a debt instrument, especially for short-term and medium-term. But investing in options which are traditional, and depending on the income group, I'm sure at least husband is in the highest tax bracket. Now, that is not a sensible thing to do because the returns are not tax efficient. So my recommendation would be that they should look at short-term debt funds where the returns can be even better as well as more tax efficient. So I think this is what they need to do to make sure that they achieve all their goals.
Investment Ladder, presented by BSC, Investors Protection Fund.
Right, Sheetal, that's the advice for you, Hemant, pretty much outlining every detail that you need to keep in mind while you plan your goals and, of course, look at making those investments and creating a retirement corpus and, of course, enough funds for your child's education and, of course, to buy that car and to buy that additional home as well. On that note, we'll take a break, but keep it with us. We'll come back and continue taking up our financial planning queries.
The Financial Planner, presented by the Bombay Stock Exchange, IPF. The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Welcome back. You're watching Financial Planner. It's now time to take up the rest of the queries over the next few minutes that we've got on the show with you. Hemant, we've got a query coming in from Abhijit who writes on his behalf of his mother. He says his mother is 57 years of age, she's a teacher at the state government primary school and has a tax benefit fixed deposit of 5 years of about 50,000 rupees in a nationalized bank. He'd like to ask you for how many years the FD certificate can be produced in order to save income tax.
This 5-year bank FD is actually one of the instruments through which you can save tax under Section 80C of the income tax. Okay. Now, this 5-year term is actually the term of the fixed deposit, which means it is a lock-in period. Right. The tax exemption can be claimed only in the first year. It cannot be claimed in the subsequent years. So I'm afraid the tax exemption will be there only in the first year and not in the subsequent years.
Okay, so that doesn't obviously carry on for the next 4 years. It's just the first year.
No, it doesn't, because the 5-year term period is the lock-in period. Okay. Not that you can claim exemption.
Because a lot of people wouldn't know that, right? Yes. Also, Hemant, a very quick short query here as well. There's one query coming from Chetan Rao. And he says that there's a rule that one has to save 10% of his income. I guess he's talking about a thumb rule for that. Does this rule include the insurance premium payment, or is it excluding the insurance payments? One has to save 10% of his income. Big, important difference that everybody needs to know.
Oh, yes. You're absolutely right. It's actually a thumb rule. Thumb rule is that you should invest 10% of your income. So I would say that, if you're paying the premium for an endowment plan or a unit-linked insurance plan, which is saving insurance plan, that premium can be included. But I think the premium that you pay if you have gone for a term policy should not be included in this.
Right.
I think that is what one should do.
Investment Ladder, presented by BSC, Investors Protection Fund.
Well, don't include that insurance premium that you're paying as that 10% of your investment rule. That's all the time we have on this edition of Financial Planner. Thanks a ton for watching.
The Financial Planner, presented by the Bombay Stock Exchange, IPF.